When a localized geopolitical conflict chokes off the global energy supply, the economic damage travels through the supply chain like a pressure wave. Brent crude surges past $120 a barrel. Almost instantly, the Indian rupee enters a period of aggressive depreciation as the national import bill expands. Faced with this external shock, Prime Minister Narendra Modi issued an unusual domestic appeal. He urged citizens to halt gold jewelry purchases, cancel foreign vacations, and work from home. At first glance, the link is not obvious. A destination wedding in Thailand or the purchase of a gold necklace seem like personal lifestyle choices. The Prime Minister's appeal functions as a calculated act of macroeconomic triage. It attempts to shield the balance of payments from the immediate impact of a massive supply-side shock. In a highly globalized, energy-dependent economy, the private consumption of imported luxury goods drains the exact foreign currency the state needs to secure essential fuel. Private spending habits become a matter of national security. The trigger for this crisis is the de facto closure of the Strait of Hormuz, the world's most critical maritime choke point for energy transits. India's exposure to this single geographic bottleneck is severe. The route carries roughly 60% of India's crude oil, 90% of its liquefied petroleum gas, and a full third of its chemical fertilizers. This abstract outlines a recent study from the Journal of Economics, Finance and Management Studies. It models the exact macroeconomic fallout of a prolonged Iran-US conflict on the Indian economy. The researchers use vector autoregression and ARIMA models to forecast how the shock degrades the economy in a nonlinear pattern across 3 time horizons: short, medium, and long term. By tracking this model, we can trace how a distant maritime blockade mutates from an abstract geopolitical event into a localized collapse of India's gross domestic product and fiscal health. In the short-term horizon, defined as less than 3 months, Brent crude spikes to $105 a barrel. This places immediate, intense strain on state-run fuel retailers who must absorb the initial price shock. The pressure immediately transfers to the balance of payments equation. Specifically, the current account deficit rapidly widens as the gap between the foreign exchange flowing into India and the money going out expands. Because India imports 85% of its crude oil, the government and energy sector must suddenly execute massive US dollar purchases to maintain the same volume of fuel. Dumping rupees to buy dollars forces the local currency to depreciate. This explains the government's intervention regarding gold. Gold is India's second largest import after oil, demanding nearly $72 billion in foreign exchange annually. Halting gold purchases artificially suppresses the current account deficit, taking pressure off the rupee. The same logic applies to the tourism vector. Foreign vacations and overseas weddings represent a purely discretionary drain on foreign exchange. Turning off that tap preserves dollar reserves for essential energy imports. During the 1991 Gulf War, a similar oil shock triggered a balance of payments crisis. Today, the Reserve Bank of India holds substantial foreign exchange buffers, and the country maintains strategic petroleum reserves to absorb the initial blow. But this short-term triage only protects the currency. It does nothing to stop the underlying supply-side inflation from entering the domestic economy. As the conflict persists into the medium run, spanning 3 to 6 months, oil holds near $120 a barrel. The elevated cost of energy begins to erode industrial margins across the subcontinent. This table isolates the model's parameter assumptions for this persistent phase. Notice the compounding variables: a 50% spike in insurance and freight costs, and a 20% drop in trade volume with the Gulf. The disruption quickly hits secondary choke points. With liquefied natural gas flows halted, domestic fertilizer production is curtailed, transmitting the energy shock directly into the agricultural sector. The model's vector autoregression data reveals the mathematical relationship. A 10% jump in oil prices raises India's consumer price index inflation by 0.8 percentage points almost instantly. Simultaneously, the capital account deteriorates. 9 million Indian workers reside in the Gulf, sending roughly $80 billion in annual remittances back home. Regional turmoil places those jobs and that incoming capital at risk. Fearing regional contagion, global investors began a foreign portfolio investment flight,
pulling billions out of emerging markets in search of safe haven assets. Compounding supply chain friction and reduced demand hit domestic manufacturing. The index of industrial production declines by up to 2 percentage points. In this medium term, the shock mutates. It transitions from a strictly currency-based problem into a systemic crisis of physical production, logistics, and capital flight. If the conflict extends beyond 12 months, the economy hits a non-linear threshold. State reserves fall below comfort levels, and temporary fixes expire. This table compares the 2026 baseline forecast against the severe, long-run war outcomes. To prevent retail fuel and fertilizer costs from devastating consumers as oil reaches $140, the government must escalate subsidies, pushing the fiscal deficit from 4.5% to 6.5%. The external account fractures alongside it. Even with consumer restrictions, the current account deficit widens to a highly dangerous 3.0% of GDP. The structural math overwhelms the central bank's defenses. The rupee faces terminal pressure, projecting a 10 to 15% depreciation, falling to 85 against the dollar. Ultimately, real GDP growth drops 2 full percentage points from the baseline forecast, stalling at 5%. A prolonged conflict leaves the state with an impossible equation. The government is forced to trade its long-term fiscal health for baseline energy security, ensuring a period of economic stagnation. This brings us back to the Prime Minister's austerity appeal, revealing a strict macroeconomic paradox. Cutting domestic consumption defends the currency, but it actively suppresses GDP growth. When citizens buy less, businesses sell less. Discouraging consumption disincentivizes corporate investment, starving the economy of the capital it needs to grow, creating a self-fulfilling cycle of deceleration. The researchers note that while these triage measures prevent a sudden 1991-style collapse, they offer no defense against the secondary effects of the war, like remittance loss and supply chain friction. The strategy acts as an economic tourniquet. It stops the immediate bleeding of foreign exchange. But if a tourniquet is left on for the duration of a multi-year conflict, the limit restricts will eventually atrophy. The only durable solution outlined in the literature requires a structural shift. True resilience requires accelerating the transition toward energy independence and diversifying supply chains to remove the Hormuz choke point from the national balance sheet. Securing the national economy requires decoupling growth from foreign energy volatility. Policy buffers and emergency consumption cuts provide only a temporary defense against the systemic gravity of regional conflict.